Hey, Jordan from Condo here. Today I wanted to talk about the Statcan report that just came out that is making the rounds right now that essentially says over 40% of Ontario condos are owned by investors. And I'm already seeing a lot of hot takes on social media, one of the common ones being that, of course, this is why Ontario housing is so expensive and so unaffordable, is because there are so many investors buying up all of the supply. And I have a more nuanced take than that, and I want to get into that. So let's hop over the PC and go through some statistics. So we'll take a quick look at the article here from Stories. Essentially, over 40% of Ontario condos are owned by investors. And you can see the chart from Statcan here that shows the proportion of condo apartments used as investment by investor type. And when you look at Ontario, you can see that just over 40% of condos owned in Ontario are owned by investors. And you can also see on the chart that different regions, different provinces have different investment participation rates. And so I want to show you this chart here. This is a chart from Leo on Twitter. Give him a follow. Basically what he did is he took a bunch of the different cities mentioned in the Statcan report and charted them by percent of properties owned by investors versus the average home price across all property types, right? And so you'll notice that there is little to no correlation between investment participation rates and average home prices, right? You can see here that you kind of, if anything, you kind of see a bit of a correlation between higher investment participation in cities that have a lot of universities and education, that kind of thing. And of course, you have Toronto and Vancouver sitting over here at the highest purchase prices, of course, in the country, but in the middle of the pack when it comes to sort of investment participation or the amount of housing stock that is actually owned by investors rather than end users. Now, he also shared this chart here, which does show a very strong correlation between rental prices and vacancy rates, which is to be expected, but I think still worth looking at. So what you find is that the cities with the lowest vacancy rates in terms of rental condos and rental apartments and rental homes too, also tend to have the highest average one-bedroom rent prices, right? So you have Vancouver and Toronto sitting around 2% vacancy with the highest average one-bedroom rental prices, and the areas with the highest level of vacancy, you know, your Edmonton, Saskatoon, St. John's, also tend to have the lowest rental rate prices, which is of course indicative of supply and demand playing out. The higher vacancy you have, generally speaking, the rule of thumb is the lower rent you're going to have less upwards pressure on those rental prices because you have more rental stock available than you do have demand. Now, the Financial Post ran an article on this Statcan report, and they reached out to me for comment. So I want to share more or less what I said. Basically, what I said is, look, we don't have a lot of purpose-built rentals in Toronto and the GTA specifically. We haven't had a lot of purpose-built since the 60s, 70s, and 80s. We're starting to see it trend back up, or at least we were pre-COVID, which is good to see, but it's still not nearly enough rental supply coming to market to satisfy the amount of renters that are in the market, right? And so what we rely on is, you have to remember, if you're buying a property for investment, you're not just leaving it vacant. You're, in 99% of cases, you're going to rent that property out. And so you're providing rental housing to the rental market. And that helps keep rents lower or more under control, right? If we were relying exclusively on purpose-built rentals and there weren't all these investors in the condo space, you have to ask yourself, where would rental rates be in Toronto? And of course, the answer is they would be much, much higher. The other thing I went on to say is that if investors weren't buying the pre-construction condos, then developers would not hit their pre-sales thresholds required by banks in order to get construction financing. And this is actually a really important point that I want to dive in on a little bit more. So as evidenced by this chart, the more housing supply you have, the lower your rental rate is going to be, generally speaking. And of course, that goes along with purchase price as well. So in order to see a slowing of price growth and more affordable homes in the GTA, well, what do we need to see? Well, of course, we need to see more homes built. That's pretty self-explanatory. CMHC, Scotiabank, RBC, all these analysts are on the exact same page. We have a housing shortfall in the GTA, and we have had a housing shortfall for well over a decade. So how do you bring more housing supply to the market? Well, a developer has to build them, which brings me to this chart here. This is one of my favorite charts that shows the profit margin on your average condo building in Toronto. Now, this is a couple of years out of date. The average government charges per unit down here is is actually much higher today than it was when I made this chart, but the percentages are more or less in line with today's current reality. So in order for a developer to build a condo building, a couple of things has to happen. Just like you and I, or most of us, go to the bank in order to get a mortgage because we're not buying all cash, developers also go to the bank, and they go to the bank for something called construction financing, right? Most developers are not sitting on hundreds of millions of dollars in liquid capital to be able to build a 500 unit building. Most of them require a loan from the bank to actually break ground and build that condo building and bring that new housing supply to market. And just like you and I have to hit certain debt and income ratios in order to get a mortgage approved at the bank, the developer has to check a couple of boxes as well. As you'd imagine, nobody's just out there giving you hundreds of millions of dollars because they like you. Now, I'm going to be reductionist for this video and not get into the nuances of construction financing. Frankly, I'm not even qualified to speak on that, but I can tell you that there are two big requirements. Number one is a minimum profit margin. Now, this will range depending on developer and their lender, but generally in Toronto, you're going to need to show on paper at least a 15 to 20% profit on your pro forma in order to get a construction loan. Number two, and more importantly for this video, you're going to have to hit what is called a pre-sale requirement, meaning that before you can get the loan to build the building, you're going to have to sell a specific percentage of units. And for this video, we'll call that 70% because that's more aligned and less with what a lot of these deals look like. So this is where it all gets interesting to me, because I can tell you from selling hundreds of pre-construction units every single year that 70+ percent of pre-construction condo purchasers are investors, not end users. So much higher number than the 40% Statcan is giving us, but this is for brand new condos, whereas their report would apply to all housing stock, all condo stock, including 20, 30, 40-year-old buildings. Now, as a building completes and starts to age, investors will sell off their units, and so that building demographic will change over time to be less investors and more homeowners. But at least when it's in pre-sales, a lot of the time, 70% of the time in my experience, they are investors, because how many first-time home buyers, upsizers, downsizers are really looking to buy something that may or may not be ready for 5 years and take on the risk of a pre-construction contract. So essentially what I'm getting at here in a very roundabout way is that in order for us to see more homes built in Toronto, investors currently play a very integral role in buying those units and allowing for that construction financing to trigger so that these homes can actually get built. So here's an article from CBC that I was also quoted in because I'm a popular guy. But more importantly, we're going to focus on Sean's take. So Sean Hildebrand is from Urban Nation. They track new housing starts and pre-construction data in Toronto. And this was for last year, for 2022. He said that investors are scaling back because of market uncertainty, because of rate hikes, and we'll probably end up with 10,000 fewer units launched for pre-sale this year versus what was previously expected. So we were supposed to see 35,000 new condos launch last year. We only ended up seeing about 25,000 launch. And the reason for that is because there was less investor demand than the years preceding. And so developers just looked at the market as a whole, said, we're not sure we can hit our pre-sales requirements, so we're just not going to launch this product. And any building that isn't launched today, well, that's less new housing that's completing in 4, 5, 6 years down the line. And so that hurts affordability in the long run. And when you look at this report from Build that Stories reported on, it states that the GTA rental housing supply gap to double in the next 10 years. Essentially, the projection is that we will see 135,000 new housing units from purpose-built rental and condo units by 2031, but that we actually are projected to need about 312,000 units. So a massive shortfall based on this projection, and this isn't even accounting for the fact that developers are now looking at the market as a whole and saying maybe we shouldn't launch at all. So anyways, let me know what you guys think. My take on this is that clearly, investors play a very important part in financing new construction. As my buddy Dan Foch likes to say, you can almost look at an investor in a pre-construction project as a JV, as a partner on that site, because they are taking some of the risk. They are providing deposits in exchange for building new housing supply that maybe wouldn't otherwise be purchased by end users because it's 5 years into the future and carries some risk with it. And as a second order consequence, we would obviously also see less rental units available, which would put upwards pressure on rental prices as well. That's it for this video, guys. Hope you enjoyed, and I'll see you guys next video.